Good morning, traders and investors. Ben at Tyndall, tradinganalysis.com. Thank you all so much for tuning in this morning. Gosh, happy Wednesday, October 27th. I can't believe we are almost into the holiday season. So we are into the Super Bowl of earnings week, as we like to call it. We've got over 50% of the S&P 500 reporting. Last night we heard from AMD. We also heard from Microsoft and Alphabet, also known as Google more commonly. Or I should say earlier in the week, Monday, we had a report out from Facebook. The report there was a little bit mixed. We saw them guide down Q4 revenue, and at the same time, we saw them authorize a $50 billion share buyback. So it's been a bit of a mixed season thus far. Last night's reports looked relatively constructive. The price movements have been fairly muted thus far. I think Facebook's initial breakout to the upside following the report this week is a great example of why you shouldn't read too much into the after-hours price action or pre-market price action when it comes to earnings reports, unless you see a truly decisive breakout or breakdown that is substantiated by adequate volume. So let's go ahead and bring in the trading analysis team. Good morning, Terry, and good morning, Alex. How are you guys doing today?
Good morning, Bennett. Good morning, Alex. Traders, how's everybody doing today?
Hey guys.
What's up, Alex? Everybody. We got rain in Texas. We've got Bitcoin moving lower, south of 60,000.
Yeah, we basically looked for a 55, 56 target. Still on a plan, but still some major levels on the upside to overcome from Bitcoin. So there is a couple of hurdles which I will talk about. And here is pretty sunny. So a couple of days of nice autumn sun. So we are enjoying at least while we can.
Nice, nice. Yeah, we had like 30-mile-an-hour winds.
Running our air conditioners. Sorry, Bennett.
No, you're good. You're right.
We still got our air conditioners running.
Good old Texas.
It is freaking hot down here in Texas. It's almost the end of October. I'm telling you.
Did you get any of that rain? Any of the rain in the past 24 hours?
No, but it's coming.
It's coming, huh?
Headed my way, I believe. Yeah.
Yeah, we got hit pretty hard. You know, when I moved to Texas, they made a joke. They say, hey, if you don't like the weather, just wait 5 minutes. It's the only state you can experience all 4 seasons in like one day. So, hey, viewers, we appreciate you guys tuning in. Pre-market watching futures here, as you saw there in the bottom left-hand corner of the screen out of the open. Pretty quiet. We'll have Terry in just a few minutes to take a look at sector focus. We'll, of course, have Alex in to take us through macro. He's got Crypto Lab tomorrow morning, 9 a.m. Eastern, right here on the YouTube channel, Trading Analysis YouTube channel. All right. Anything else before we jump into the show this morning?
I'll just lead you in with we're in the peak of the earnings season, and so pre-market futures are kind of quiet this morning. I guess they're anticipating and waiting on some of the most important tech earnings that are yet to be released. So far, I think the majority of the companies I've been seeing have been meeting or beating their earnings. So I haven't seen anything too negative so far.
Yeah, definitely. I think as we reach, maximum accommodation and the Fed tapering, it would be wise to see, obviously, not only meeting and beating current quarters, but guidance increased moving forward. So that would be the perfect world, but we're open to all possibilities. So we've got Apple and Amazon reporting Thursday. We had Boeing this morning. We had McDonald's this morning. Pretty nice move there in McDonald's. Reporting earnings this morning.
McDonald's beat.
What was that? 237 trading into the close yesterday, up to 244 here in the pre-market. Looks like some decent volume. So we're not going to read too much into it. We'll let the week speak for itself. We'll take a look at the hard right edge of the chart, see if we can dissect the collective underlying sentiment of the current indexes, and we'll take it from there. Sound good? All right, gentlemen, I'll be back on the other side. See you guys in just a few minutes. Alrighty, welcome back once again, and thanks again for tuning in. Let's jump into it. Hard right edge of the Motive Wave platform. Let's take a look first at price action in the S&P 500. And what I want to do for you here this morning is identify where we view markets in terms of the Elliott Wave count, then discuss an alternate possibility, which is one we should at least be considering given the current situation with yields, and given the fact that we are into the Super Bowl of earnings week. So jumping into the daily chart here first of the S&P 500, we've been operating now pretty much under our alternate count. Going back to the COVID lows, there has been a lot of subjectivity surrounding the Elliott Wave count in the indexes. There was clearly a lack of clear corrective trends, I should say, coming off of the March COVID lows, and therefore, as a result, you're left with multiple valid Elliott Wave interpretations. Fortunately, the valid wave counts that we do have at our disposal to work with are all supportive of continuation on the upside. So let's jump into it. We're looking at a wave structure going back to the bottom left-hand corner of your screen, which is the March COVID low. From there, the largest percent retracement, the largest correction that we have seen since the March COVID low occurred for both the S&P as well as the NASDAQ back in September through November of 20. That correction you can see here that we are labeling as wave 1 and 2 of the orange primary degree. Moving from the November low, we see 5 waves up. It's kind of interesting. You can go back and dissect a chart and kind of remember what was happening in the world. November 9th, we had the first positive coronavirus vaccine news. That completed wave 1. We get wave 2, up in 3, down in 4, up in 5. This was a nice 5-wave trend. So from November, or excuse me, yeah, from essentially the October 30th, November 1st area low in through the February 13th high, we have a completed 5-wave motive impulsive trend establishing rally. Okay, that's then met with 3 waves to the downside. That 3-wave pullback concluding in March presented 5 waves up. The 5-wave rally into March 17th took us through a new high, so we broke through the February 15th, 13th area resistance, established a new high, but we didn't confirm the uptrend resumption until the corrective pullback that followed here in green wave 2. That green wave 2 was a standard 50% retracement, and you can see the impulsive continuation from there. This is when we had suggested the breakout through 4,000. So here's a nice 5-wave move up, 3-wave pullback, another 5-wave move up, 3-wave pullback. We made note of the fact that despite the subjectivity of the wave structure and possible counts from the COVID low, that we continue to see the 5-wave motive impulsive or motive diagonal structures to the upside, so from the bottom left to the top right-hand corner of your chart, and we continue to see the corrective 3-wave retracements to the downside. So until we see this collective underlying sentiment shift, we see no reason to go against this market, even with the uncertainties facing it. So from March 1, 2, up in 3, down in 4, green wave 5, we propose concluded as an ending contracting variety diagonal. There are a couple of different ways to decompose this. All of them are valid, and they all arrive at the same conclusion. That is, your blue 3rd wave of the intermediate degree concluded in early September. From there, we get the 3-wave pullback into October 4th. Notice the October 4th low in the S&P 500 had a low of 4278.94. A quality of percent retracement in this wave 4 compared to wave 2 came in at 4284.53. So we did demonstrate equality. We have the guideline of equality at work. We don't quite have the guideline of alternation, but I would argue that we do, in that our B wave in our wave 2 retraced beyond 78.6%. So this was still technically a zigzag structure in that we had 5 down, 3 up, another 5 down in C. It unfolded with slightly different characteristics than the wave 4 that we propose concluded in October 4th, or back in October, early October here. So now we are looking for upside confirmation, sort of like we had back here in March. Corrective pullback, 5-wave trend, 3-wave retracement, upside continuation confirmation. So let's jump now down off of the daily and dissect the upper right-hand corner of this chart. We'll go daily down to the 20-minute time frame. Now, from the 20-minute chart, we can see the upper left-hand corner is our September 2nd area high. We have a 5-wave motive impulsive trend to the downside in green minor degree wave A. We then retrace in a 7-swing structure in our B wave, and then we unfold in another 5-wave impulsive decline into the October 4th low. Now, the market makers and market traders and participants in general did a good job in the morning of the, I think it was the 6th here, when we had seen what appeared to be 5 back, then we had a breakdown in the pre-market overnight. As discussed last week, that was simply traders taking advantage of the range expansion that unfolded as a result of this correction. So we ultimately maintained October 4th support, move up in 5 waves, correct down in 5 or 3, correct back to the upside in 3, and then we have a 5-wave decline to conclude wave C of wave 2. This is an extremely well-disguised flat. Unfortunately, the B wave's significant external retracement of the A wave decline made it a little less likely in real time that that was the case. But from the wave 2 flat concluding October 13th, which is the day we had the Fed minutes shed some light on the tapering plans, we've been on a very sizable rally here that has taken us now into a new high in the S&P 500. We have met our 261.8% Fibonacci projection of our 3 compared to wave 1. If we were to, for some reason, entertain the idea that this is a 3-wave motive wave, which we just simply would not do, let's do this a valid way. Let's say wave 1 really is here, just to get the Fib projections changed. We'll call truncation in green C. That now puts us into a 1618 to 200%. Very appropriate stopping point for the index. So we now have what we feel to be at or near a completed wave 3, looking for a corrective pullback in wave 4. This corrective pullback in wave 4, I do feel, will present a 3-wave retracement similar to what we saw back in March, and will offer traders an opportunity to position for a confirmed breakout move on the upside. Now, what happens if Apple, Amazon is a major disappointment and we do see guidance that is concerning given the potential Fed tapering or likely Fed tapering starting this year, and we see the indexes break down? What if we don't maintain wave 4 support and we start to push all the way back to the October 4th low? Would I then, and this is the alternate I mentioned out of the open, would I then be bearish the market? And the answer is no. The answer is no for a couple of reasons, but primarily due to the fact that taking you back here to our, we'll go 195 half-day chart this time, taking you back to our comparison to our March corrective retracement zigzag, should we suggest alternation, excuse me, should we suggest alternation is going to unfold here at a more appropriate, in a more appropriate fashion, then what we have evidence of is 3 down and 3 up. So if we break lower from here and we do exceed the A wave low, would I view that as a major market top? Absolutely not. I would then support the idea that we're simply alternating our corrective patterns. We had a zigzag back in March. We're doing a flat here in October. This is the back of the pocket count. This is something that we keep as an alternate to have a game plan in the event plan A does not go our way. For instance, plan A being we see a corrective retracement, find support, and continue higher. If we don't find support and we start to break lower, as opposed to scrambling for context to understand what's happening, we will already have the alternate view at work. So that's the S&P index. Let's jump over to the NASDAQ. Here in the NASDAQ, we're tracking a very similar structure. Taking you to the upper left-hand corner of your screen, you have the September 7th high, 5 waves down. In this instance, it wasn't motive impulsive, it was motive diagonal, in that you have overlap between your corrections wave 4 and wave 2. We then retrace in a 7-swing structure into September, and then we have a 5-wave decline. Here in the NASDAQ, we saw the C wave demonstrate equality to wave A in terms of magnitude of decline. And very similar to the S&P, we have 5 up, a sideways flat, another 5-wave move up. We met the 2618. Yesterday's market high of 15,710.79 was just above the 15,666.72. From there, we'd be expecting a corrective pullback. But again, just like the S&P, if we were to break down from here, we would not be viewing that as a major market top, but instead wave C of an overall flat and viewing that then as the overall wave 4 correction. Let's take a look at the Russell 2000. Russell 2000 small caps have been sideways in consolidation since February of this year. We were tracking the possibility that back in July, the wave 4 correction came to completion and we've been moving impulsively on the upside. This wave count, while not wrong, is less likely than our alternate count, which still shows us moving on the upside, but in a little bit of a different fashion. So instead of this being one ABC flat 2, another 1-2, smaller 1-2, which by the way, when you have 3 degrees of trend failing to break through the parent wave's high, you might want to go for a recount. The alternate view then is in fact that while that wave 4 we view having concluded back in July and the initial wave structure being 1 flat 2, we now have a leading contracting variety diagonal for wave 1 of wave 3 of the 5th. That then supports the idea that the Russell 2000 can see a correction to the downside along with the S&P and the broader, or I should say the broader S&P and NASDAQ. One chart we don't look at very often, Dow Jones Industrial. Sorry, I heard the birds squirking outside. Taking a look at the Dow Jones Industrial Average, here's another strong example of a motive trend from the recent corrective lows. Allow me to adjust time frame and adjust scale here. So from the August area highs in the Dow, we see a period of sideways consolidation, lower highs, higher lows, classic contracting Elliott Wave triangle, possibly. And from there, we can count 5 waves up, nearing completion in an ending contracting variety diagonal in orange wave 5. We are just shy of the 1272 external retracement of this wave 4 decline, and very similar to the S&P and the NASDAQ, in the event we do start to break lower from here and break through the September area low in the Dow, we would then be viewing this as A, this is B, looking for impulsive continuation in C, and then resumption on the upside. Semis, we'll touch base with semis. Taking a look at the SMH, one of our preferred methods of tracking this particular industry group within the technology sector. And what we have here is from our September high, ABC correction to the downside, 1 flat 2, up in 3, A, 3 up in B, reject the 1272. This says semis are already possibly in that wave 4 and could potentially find support in the near future here and break higher in wave 5. Now the last chart I'm going to put in front of you this morning, as I failed to do so last week, is the chart of the 10-year yield. And taking a look at the chart of the 10-year yield, the major question that we've been looking to answer from an Elliott Wave perspective is if in fact price action from our recent July and August area lows, is the price action corrective? Is it a 3-wave correction and going to result in a further move to the downside in yields, move back to the upside in bonds, or is this the start of something more impulsive? I do think we are close to finding that answer out. Based on the continual move above the 786, it does appear to be impulsive. We see 5 waves up being met with a sideways flat in 2, smaller 1, 2, 3, 4. Blue wave 4 did demonstrate equality to 2, met its 38% retracement. We now see what appears to be an ending contracting diagonal to take us to our 1.75%, 1618 projection. We then see a likely 4th wave pullback. Then we could see the 10-year moving up towards 2%. All right, that is it for me this morning. I apologize for going a little bit longer than normal. Team, Terry, Alex, so I didn't mean to encroach on your time there. What do you guys think? What do you guys think?
I just, in concert with that, I was just noticing pre-market move in crude oil down sharply about 1.25%.
Beautiful.
Crude markets closed yesterday at like 1:30. They closed 1:30 Eastern time, right? Yeah, it looks like there must have been some announcement I didn't see. So it looks like energy stocks are dropping in concert with the price of crude.
Yeah, crude's an interesting one. We do think there's likely a move to 90 coming, but we have some 3-4 corrections to pair up, I think, before we can make that happen, at least from a technical perspective. So, all right, Mr. Terry Long, sir, let me get the Motive Wave window out of the way. You ready to take us through sector focus?
Ready to go.
All right, let's hit it. Terry Long's going to take you through Optima. We'll be back on the other side.
Hello, traders. I'm Terry Long at tradinganalysis.com with your weekly sector focus. Now, this past 3 weeks in October, we've watched these indexes rally higher each week. Last Thursday, the S&P set an all-time high on 4549.78. Friday's price action settled down just 5 points from that all-time high. A little bit of a doji candle formation there. But Monday saw the S&P push again to another new all-time high, closing at 4566.48, and then another little doji here on yesterday. The NDX also rallied higher for the past 3 weeks. However, it is just now approaching a 100% retracement of the move. So S&P had already gotten to that 100% retracement last week, and then last week's we were only about a 786. So the last push that we had, intraday highs yesterday, set a new record. Closing levels did not, though, but we do have very strong continued performance here in the tech-heavy index. Now, the top performing sectors last week were real estate, healthcare, financials, and utilities. All 11 sectors were positive, but energy, materials, staples, and communications did lag behind the S&P. Now, while we saw the S&P push to another new all-time high, I mentioned that the NDX did not break through that level. We did see the S&P, we did see the NASDAQ rise 1.33% so far this week versus the broader market S&P only 0.66. So we got a 2-to-1 ratio going on here in the race for championship. Now, so far this week, we've got consumer discretionary, Monday and Tuesday's price action, consumer discretionary leading the markets higher, up 2.95%, 2.97% this morning. Primarily driven, but not totally, by Tesla's double-digit gains. Everybody's had eyes on Tesla, I know, and it's not the only reason to have the XLY that high. Lagging sectors this week so far are communications, industrials, and financials. Now, this past week, our sector rotation actually had 0 sectors occupying the leading quadrant. Now, that will soon change and has now changed as we see financials and consumer discretionary push up here into the leading quadrant. And the energy sector has also continued to rise higher up here into the improving quadrant, and very likely will be joining financials and discretionary over here in the leading quadrant. Technology and real estate, they remain down here in the weakening quadrant, but notice the trend change color there in real estate. It has started a northerly hook last week. Faded that hook a little bit, still pushing to the west, but I do have a green marker here on the vector, which tells me the weekly trend is improving. Weekly trend still improving, even though we do have a southwesterly vector here on the XLK. Now, while September's decline in the XLK was about at 8%, the rally is recouped 100% or more. Let's get that XLK chart up here for you. Yeah, here's the XLK. So we've got about an 8% overall decline, and that rallied back with yesterday's move, setting a new all-time high in the XLK. Now the weekly RRG here in the XLK is really still kind of what do I say, in a disarray, but we are starting to get some organization. Let me come back to that here. So the what do I want to say here? Technology, the communications sector. Yeah, that's where I want to go to next. Communications sector crossed over here into the lagging quadrant, and it's still on a southwesterly vector. Okay, so rising up out of the lagging quadrant, we do have industrials and materials, but I'm just now with this last move starting to get some move or shift back to the right, indicating a little bit of relative strength gains. We really need to see these two sectors start to move further east, indicating more relative strength gain as they rise up here into that improving quadrant. The staples and utility sectors are also still lagging well behind the benchmark. So that's all I've got for today. But I will tell you, I'm seeing some very positive things. I will ad lib a little bit here on the XLY and tell you that, XLY has done at least a 100% retracement. You're getting a little bit of a pullback here in the last 3 days. Sorry, this is Ford Motor Company. Let me get the right chart up. There we go. That's what I wanted to see. This is the XLY. So the XLY just continuing to push to new all-time highs. This is one I called out early in October. I said we've got a breakout coming here. You can see the 20 moving above the 50 rapidly here starting the week of the October 8th. But I know I was getting my signals were starting to all align. All the stars are aligning back here early in October, indicating the move was going to be in the XLY and the XLF. The XLF has been doing quite well as also. Tesla is up 14.5% this week. Best Buy, Las Vegas Sands, Etsy, Ross Stores, VFC, TJX, Booking. McDonald's reported beat earnings this morning, so we'll see how McDonald's plays out today. But I did see that Hilton missed earnings. So I think Hilton's up 1% this week and Marriott 0.83, but I think you're going to see some downside pressure there as well. And this is the last sector I'll take a closer look at here for you. That's the financial sector. Again, all my indicators positive as we continue to push to a new all-time high. Strong uptrend in progress. This is you've got a very well organized relative rotation chart here. You've got a lot of leaders. Doesn't matter that these leaders with these very high relative strength are seeing declining momentum. Okay, I'd be more nervous of the ones that are over here rather than this grouping of leaders right here. But in addition to this group of leaders, you've got a very healthy secondary group of leaders. Truist Financial, MetLife, U.S. Bancorp, Schwab, etc. All of these guys, Bank of America. I'll animate this back here for you and show you that we picked up on this move. Sorry, I went too far. We picked up on this move starting back here end of September. We could see the turn forming, the hooks forming. Then we got the blue weekly improving trends. And this group that we identified back there has advanced very nicely over the last 3 weeks and will continue, I believe, with these vectors telling us that the strength is still in these stocks. Momentum plus relative strength gains are going to continue ahead for many of the stocks in the financials. Bennett, back to you.
Much appreciated, Terry. Thank you so much. All right, Mr. Alex, sir, we're going to get the presenter mode past your direction. We've got about 10 minutes to market open. Futures are bouncing back just a little bit. Not a huge move yet. Speaking of Ford, Ford retraced beyond the 786 retracement of its all-time high, so things could get interesting there. I'm going to keep my eye on that chart. Excellent job, there, Terry. Much appreciated as always. Let's keep our eyes on consumer discretionary. And to your point, everybody's so focused on Tesla, likely missing some other opportunities there. All right, Alex.
You got the screen, Alex.
You ready to hit it,
Yeah.
sir?
Yeah, let's go.
All right, let's jump into it. Here we go.
Hey guys, as usual, let's go and see over a little bit of macro development here. Let's start with the 10-year yields. Bennett already showed you his wave count, so it agrees with also my view, what actually I'm looking here on that front. So we still are looking how to perceive this move, and for now we have it as an ABC, at least I do, for potential test of this 2% higher resistance levels. So if we see this continues further on the upside, I'm afraid we will have to above this 2% after a small pullback, we will have to turn this ABC into a more impulsive move on the upside, where the next target will be around 3.3. That is still far behind, so let's see what is going to happen here. Next resistance levels will be around 1.95 to 2%. And as you can see, we are experiencing here a little correction. Bennett has it as a ending diagonal in this smaller degree wave 3, maybe a small pullback into wave 4, and then a continuation towards this equality. So these two legs, A down in B, up in C, are equal as 2.0616 actually will be a measured move. So most likely we'll get to there relatively soon, in a week or two, and let's see what is going to happen from there. Definitely the next Fed meeting will be pretty much telling what is going to be happening with rates and tapering. The vocals are pretty much starting to heat up, especially as the COVID crisis is starting to be a little bit more present in a sense of cases, and all of the stuff that we are doing in the world, trying to kind of bring more measures in regards to tame it. And also we have Jerome Powell re-election next year in February, so his fourth term is expiring, and there is a different things going on. So I think it will be interesting next couple of months for the Fed. As you know, the two governors, which was actually stock trading, which was from the Fed point of view perfectly legal from the trading side, but compliance side, but from the moral ethics side, obviously not. They resigned. And I think it will be mostly a political decision. And for now, we don't know, is the Powell a favor of Biden administration to continue its term? So I think a lot it's going to go on there, and I cannot wait next Fed meeting to hear the outlook of what they see, what is going to happen with rates. In Europe, we are basically moving still sideways. Still triangle is a potential. I still look this as a fourth wave pullback with a maybe 2022 still moving sideways or a little bit more directionally down. I've been looking this chart for already a couple of years, and it's moving pretty predictable if you follow the Elliott Wave path. So it's not so invisible until we trade above this support that this might be potentially wave 4, and when it's done, we're going to continue up in a wave 5 in a more deflationary manner. So looking at the dollar index, we are still kind of a three-wave pullback holding this support. I think this is a small, just a pullback triangle. I'm seeing dollar moving higher towards the near or maybe a little bit before end of 2021. So there is a room on the upside towards 96, or in the extreme case, 99.06. So when you have this ABC relation or a measured move, most common target is equality, but it can extend to 1618. That also we have seen practicing this already for more than 10, 12 years. So I'm still going to retain my stance that dollar is still bullish, and I still think that we have some more upside before we turn pretty sizably lower, and a 5-wave move from this top breaking these resistance levels will indicate that after this measured move we might see a continuation of a dollar weakness in next year or two to come. From the gold side, still triangle, so we didn't see anything so I mean important in the gold market. We are moving towards this target that we labeled as a D wave. When you have these legs in triangle, and as I said, I keep this triangle because this very important levels around 1670 held nicely. We are still trading above that. We are still trading in a potential move up in a wave D, and I'm gonna look for a little bit more upside in gold, and then a correction down in a wave E. So I still have a
zoom in on that a little bit for me, please.
Sure.
A little bit closer, because what I was seeing in my shorter term, draw me a trend line from that green B wave through your next A wave high. Your green B on the left over there in June 21. Your green B.
You mean this one?
Yeah, draw me a trend line from there down through there. Yeah. So this past move that we just saw looks like it's penetrated that trend line, but it also looks to me like it got sharply rejected. So
Yeah.
so I'm kind of tentative as to whether that's going to turn from a resistance level to a support level. But I could certainly see if it does find its legs here, that we continue in the short term to move higher, a little bit further out in time, maybe for that green D wave, in my opinion. But I can certainly see this playing out.
Yeah, I mean, for now we are holding steadily these levels. We didn't break to the downside, so most likely we're going to hit it. If we surpass this on the upside, try to test 1900. So there is a couple of other forms which might be in play. Also flat if we start to test some higher levels here. But I would like to stay with the triangle because it goes well. Also with the silver, it goes well also with the US dollar index wave count. So I'm still going to stay as my primary wave count with a triangle. Also kind of a matching a time very close to December, January of 2022, December 2021. So I think we are closing here. And I saw also some charts and some valuations on the sector stocks, which are actually covering miners which are underlying basically the gold price. And some of them are looking relatively kind of setting a bullish setup. So I think this goes well.
Yeah, I agree with that.
So I think that we're going to see higher gold relatively soon if we continue to see this sideways trading. And the first 5 waves from this breakout will mean possibly we're going to continue up to above 2000 and even above on the upside. So basically same thing, sideways consolidation, waiting a breakout. Silver is also still doesn't give us so much of a 5-wave move for now. I'm still going to look this as a wave 4, looking a little bit more downside. Maybe this is already finished. I don't know yet. I need to see a breakout in a 5 waves. Also alternate is a big triangle, but I think this range will be maintained. We might get down to see one more test of this 2120 levels, but I think silver in 2022 is going to turn bullish on the upside, testing these 3740 levels upon the breakout of this already year-and-a-half long consolidation. So I'm going to stay bullish metals overall. As a Bitcoin is concerned, there is a couple of things that we are looking on a Bitcoin chart. As you know, we have looked for a smaller pullback last week, which is now actually occurring. To my view, there is a couple of very strong levels in a Bitcoin. I have moved this first resistance levels to 50K, 51, 52K. Next one is very important, 40K resistance, which I don't think we're going to break so easily, let alone 30,000. I'm generally, when I saw the 40K was holding, I generally shift my bias from neutral to bullish. And I see these two levels as a main threat currently for a Bitcoin price. I think we're going to get up from 72 to 80K, where this 127 for a possible flat and 200 from a higher degree 3:1 ratio rests. So if this starts to hold and we see a 5-way move down, we might be facing with a running flat or an even expanded flat or still a triangle wave count. So I will not be so sure yet that we will see a huge breakout on the upside until these two levels or this zone is cleared out. And when it's cleared out, I think 100K or above will be a pretty fast affair if we decompose this in a 5-way move towards some 130, 150, and even higher. So I want Bitcoin, this price, to clear this zone. If this zone is cleared without a problem, I'm going to become increasingly bullish on the follow-up above 100K to follow. So yeah, I'm still kind of not so. I think that when we see some of the wave counts, which still can be that this is a larger degree wave 4, I'm still not all in. We will buy this small pullback towards this 72, 80K. But from there, I want to see what is going to be happening in this zone, which I consider to be very important one for the crypto continuation on the upside. So back to you, Bennett.
Much appreciated. Thank you so much, Alex. All right, markets are open. We've been open about 3 minutes so far. S&P 500 moving lower. NASDAQ hanging out right at the 15.6 handle. Tesla, we've got, gosh, north of $1,000 a share. It's been an interesting move there. So, hey, we appreciate you all tuning in. Thank you for taking time out of your Wednesday morning to do so. Alex will be back tomorrow morning right here on the Trading Analysis YouTube channel, 9 a.m. Eastern for Crypto Lab. If you guys are interested in more crypto-specific related coverage, you can check us out anytime, tradinganalysis.com. Give us a thumbs up and subscribe with notifications. Let the YouTube algorithm know you are enjoying the content. We would greatly appreciate it. Team, appreciate it. Terry, Alex, members, we'll see you guys here in about 26 minutes or so for the member webinar. And YouTube will be back, same time, same place next week. Any final words of wisdom before we let them? Not yet, Terry. I've got to finalize something on that. All right. Sounds good. Be safe. Stay healthy. Stay away from the COVID germs, and we'll leave it at that.
I'm still muted.
Oh,
hey,
you're
is
good.
it daylight savings time this weekend or not?
That's a great question.
I don't. If it's this weekend, we're going to get all screwed up with our European clients here. So.
No, it's November 7th. Yeah, it's the first week of November, so the end of the first week of November.
We got one more week. Okay.
Yeah.
All right.
We're going to gain an hour in 2021, huh?
Yeah.
Oh, that's dangerous. All right, we appreciate it. Be safe. We'll be back next week.
All right.
Sounds good.
See you guys later.
All right, take care. See ya.